Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. Hey Mohit, how's it going?
Good, how are you?
Good to be back on the Energy Desk this week. Excited to talk to you about what's been going on in global energy markets. Definitely a few updates kind of all across the board. So I think maybe today, a good opportunity to kick it off with crude and the Middle East, which connects to broader kind of macro events that have been on the radar. So, I think maybe we kick it off with some U.S.-Iran dialogue and OPEC dialogue and how crude has been performing. Is there anything in there that jumps out that you want to start with?
Sure. I think the Middle East headlines always have the ability to move the market as the next headline comes along. But I think the bigger movers had been over the past month, where initially it was the tariff concerns on how they would hit demand. And then that kind of took a backseat to recent worries about OPEC and the concerns that the Saudis are going to be quite aggressive in trying to bring back barrels because they really want to take care of anyone who's cheating, who's not following or towing their line and not trying to behave as a team.
Yeah, let's dig into that actually. So there's the OPEC May meeting, which was moved from May 5th to May 3rd this weekend, and kind of the discussion that you were mentioning. So in May, they're planning on bringing back 411,000 barrels a day of that offline production. And then this meeting that was just adjusted, they're discussing potentially doing that again for a 400,000 barrel per day increase in June. So back to back over 400,000 barrels per day for each of those, which the first one was basically 3 of their scheduled increases lumped together. So doing that consecutively. And as you mentioned, the big question kind of related is, with all that supply, is demand going to be at a point to kind of absorb that increase? And, on what you were mentioning with the punishing kind of overproducers, consistent compliance issues within OPEC for months now, Kazakhstan, UAE, Iraq in there. And I think we'll discuss several of the other potential considerations, but, they've had the lowest production since 2010 for Saudi Arabia and, potential for an interest to recapture some of that market share. Seems like a big push. But then, as you have the OPEC commentary, I think the other element to consider in here is what's going on with Iran. So what was your take with some of the updates this week?
No, I think they pretty clearly said we're going back to a maximum pressure policy on them. And I think with their negotiations being postponed, they say it was just logistical, but that could be a code word for it's not going well, because right after that came the commentary that, okay, all secondary sanctions, I'll let you cover more of that. But basically they're putting on a full court press, which is kind of where it was in Trump 1, where it was like they could not get their oil out.
Yeah, and you had the dual impact of, COVID in there, but you have Iranian production. I believe the number top of mind was over 700,000 barrels per day that was cut off pretty quickly. That does kind of raise the question. You have the round 1. I think Iran and several of the sanctioned groups like Venezuela kind of fits in there. Russia kind of grouping together, pooling their sanctioned taker fleet, their dark fleet, to evade those sanctions. So there might be a little bit of a harder time for enforcement of those. But I think where Trump, as you mentioned, coming out with this True Social post the other day saying that any buyers of Iranian crude are going to be hit with secondary sanctions. I think the read through is that's specifically talking about China. And, China through 2024 imported over 90% of Iranian exports, about 1.5 million barrels a day on average last year. And then for January, brought that back under to about 900,000 barrels per day. And I think that was a little bit of a soft signal. Hey, maybe we're willing to work with the U.S., maybe we're not. But then that pretty quickly transformed in February and March into 1.7 to 1.85 million barrels per day. So that's on the highest end of China's imports of Iranian crude for, the last several years. So I think that's a pretty clear signal as well that it's kind of two birds, one stone in many ways. That if you can dissuade China from buying that, really those independent refineries in China, the teapots, if you can dissuade them from buying Iranian crude, then you'll potentially have a shot of bringing those exports under control. But I did think it was pretty interesting because you have back-to-back kind of events. As you mentioned, the commentary about postponing those nuclear negotiations was one thing, but then coinciding, you have Secretary of Defense Pete Hegseth saying that Iran's going to be held responsible for Houthi attacks in the Red Sea. And then on Wednesday, you also had the Treasury coming out with new sanctions on several entities that are involved with Iranian crude trade. So many factors in there. I guess my question for you is kind of what's your perspective on the relationship between Iranian barrels and OPEC's, upcoming supply increase? Is that enough to make a meaningful difference, or do you think it's purely to get those compliance issues taken care of?
Yeah, I think that'll be interesting in terms of OPEC and the Iranian sanctions, because if you do get those sanctions hitting, in a way, it allows Saudis to increase their production without total production going up. And that was one of the things which I think we talked about a while ago, is when Trump came in, it was potentially sanctioning Iran, Venezuela, and Russia. And then where were those barrels going to be replaced from? Well, OPEC had held back so many barrels. It was very easy for them to bring some of those back. So how all that plays out, I think, remains to be seen. But in the meantime, I think what you're seeing from price action, sellers have been out as the commentary of OPEC increasing, like you said, rapidly increasing their production, or bringing back barrels, I should say. The sellers have been out in full force.
Yeah, it'll be interesting to see if that gets exhausted as well. I don't know. The Saudi side, so 200,000 barrels a day of that May 411,000 barrel per day increase. 200 is Saudi Arabia's. So, you can meaningfully, or I guess more clearly see that, any impact to Venezuelan and Iranian crude, I could see a much larger impact than the 800,000 barrel per day increase. So, you have Venezuela producing about, 1 million barrels, exporting a good chunk of that, and then take that back down. And then Iranian production, it's not that hard to come up with the 800,000 barrels. But you do still have to consider that OPEC has plenty of spare capacity still online, or offline rather. So,
offline,
yeah, kind of an interesting one. I think we'll get some more confirmation on that after this weekend. So by the time this comes out, listeners will be able to kind of compare that to the news. But then on the demand side, I think the other part to consider is all the economic data that came out this week. And I'm sure you saw pretty similar headlines, but it seemed like there was a big push to make more of some headlines than others. And what was kind of your perspective of all the economic stuff in the US and elsewhere?
Yeah, let's start with today's, and then I'll let you cover some of the GDP stuff. But today's job report was expected to be pretty weak because it would have covered a lot of the tariff portion of the month, so to say. Right. But it was surprisingly strong. And the interesting part was that the private sector jobs were up a lot more than expected. I think expectations, if I remember right, were about 125,000, and it was actually about 167.
Yeah.
We also had more labor participation, which is always a good sign. That's telling you more people are coming in to the workforce. And the work week expanded. Hourly earnings rose, and I was looking at the stats there. It was like 3.8% year over year. But then that's far more than the consumer price increase, which is about 2.4. Yeah. So that's a good thing for the consumer in the sense that earnings are going faster
than inflation.
Costs are increasing.
Right. Yeah, I think that, the jobs data today, and then, earlier this week, I'll dig into the GDP print versus commentary after, but I think as you mentioned, the PCE, so price consumer expenditure, PCE inflation data, which the core of that, stripped of food and energy, is the Fed's preferred inflation metrics. There's two elements there. On the PCE all items, you're flat month over month, so 0% growth month over month, and then 2.3% year over year. For the core, so stripped of those food and energy items, you're looking at flat month over month as well, but then 2.6% year over year, which is the lowest since before this, crazy inflation period we had in March 2021. So I think those are very positive for the inflation side. And when we're talking about the Federal Reserve, it's kind of an interesting directive that they have where they're looking at inflation and the labor market. And so I think this kind of puts the Fed in a little bit of a spot to kind of answer the question, are you politicized? Are you not politicized? Because you have the good indicators for inflation that you're bringing it under control, and the labor market is still fairly healthy. And you have some indications that, all right, it's potentially time to relax those rates. So we'll see if that actually happens. I don't know. My take is that near term, probably wouldn't expect a cut, but over the course of 2025, maybe there is kind of some upside potential, some surprises that are in store relative to market expectations. Do you have any thoughts on the Fed side of that?
Yeah, I think I completely agree with that. And the one other piece that they are watching, which they were talking about in their recent commentary, is that we are watching the labor market carefully. And yes, it is healthy. But again, if you read the news, it's like we're going
straight recession
downhill really fast. Yeah. Right. Which means that the labor market is something which they're probably watching carefully. And if there's any sign there, assuming inflation is already going lower, then if they do not reduce rates, then it is definitely that they are behind the curve, because there's no reason for them to be waiting if both those mandates are consistent with what you're observing in the data.
Right.
So that would be my take, is just watch the employment data, and definitely they should have room to cut.
Yeah, it seems that way. And I think when you look at the Treasury curve, you have fairly strong indications there as well. So I think 2-year, not sure what I'm looking at today, but 3.7% yesterday, or under. So I think there's definitely some room to go. But on the GDP one, I think that's also an interesting headline versus reality type of conversation this week, because you have the negative first quarter print minus 0.3% quarter over quarter. And really, where does that come from? And when you look at the headlines, it's, I called it Chicken Little headlines, sky is falling. But when you dissect what's actually going on in the data, you have to look back to Tuesday's economic release. And so on Tuesday, the Census Bureau came out and said the U.S. goods trade deficit hit a new monthly record of negative 162 billion. So that's the third record in 4 months. And that really points back to those importers through 2024, but also, starting really in December after President Trump won November's election, saying, okay, we're probably going to see tariffs come in. We got to get these goods in before those come into place. And so we definitely saw that come into the data. Imports just skyrocketed. And how does that fit into the GDP conversation? Well, imports are the negative driver of that negative print. So take away the record imports and you'd see very healthy U.S. economy. So I think it's a pretty interesting kind of myopic lens that a lot of the, mass market media chooses to use. But if you take those imports away, you're looking pretty good. And then when you look at quarter two, which I think is really the most important, is what are kind of the drivers at play. So one, you're probably going to see imports slow down as, the import rush kind of already happened and tariffs are in place in some capacity for different countries. So probably see imports slow down. Conversely, see exports probably improve. And so just kind of general tailwinds, you have a lot of these export-centric nations trying to secure some U.S. energy and other supplies that will kind of reduce their trade surplus against the United States, kind of reduce that, I call it the tariff target surface area with President Trump in office. And then, the other side is the trade deals. And so when we have all of these trade negotiations going on, we're looking most likely at Q2 announcements for several of those. The ones I'm watching are going to be Japan, India, Vietnam, kind of those Asia export-centric markets that are most likely going to be the energy demand growth drivers of the next 10 years as China kind of slows down. I don't know if you have a take on anything in there or want to add.
Yeah, I think the trade deals are definitely going to be something to watch. And one of the things I was reading is, or listening to some people and saying, oh, but how are they going to do 90 or 120 or 200 trade deals? Well, all you really need is 2 to 4 of them, because that gives you a very clear blueprint of how the rest of them have to fall in. So once they get a few, I think the rest can come in pretty fast. And I completely agree. It's going to be the Asia, like Japan, India, probably, and Vietnam. I think they've already talked about good progress there. Yeah. And I'd say in Europe, you've got UK and a couple others who are probably going to be quick.
Yeah, I agree.
That could provide some good tailwind. And the other thing, coming back to your GDP commentary, one of the interesting things I read was that it is not the consumers, the businesses that have pulled in extra imports before the tariffs. The concern was that if it's the consumer, then that takes away from future demand. Yeah. But that's not the case. The consumer has been just fine.
So, the inventories.
Right. So the demand side is not going to be impacted by that. So those are the two things which I want to mention there.
Yeah, I think your point about the wage growth is also one to keep in mind in regards to that and how spending performs. So, I think that's kind of a good summary of some of the economic landscape. And I think bringing it back to some of the energy focus, there's kind of two areas that I'm curious to get your thoughts on. One is some of the positioning data, and then the other is I guess there's three. So fundamentals and then kind of changes to the curve and in different markets. Is there any one of those that you want to kick it off with?
Yeah, let's start with positioning, since we've covered that in the last couple podcasts. Yeah. And oil positioning stays short even now. And in fact, I think from the latest Brent positioning, I think they got shorter.
Yeah.
So the market is pretty short. And like we touched on earlier, it was tariff related, demand worry, so they sold everything. And now what you're seeing is it's more supply related, but supply predominantly of crude. So what you're seeing there is that the cracks have started appreciating. Because if it was demand, then it would be the products which would be accelerating to the downside, because they're pretty rich. They're about $26 on both diesel and gasoline. Yeah. So it's really more a crude selling. And of course, that's also, exacerbated. But one thing to watch is, given the market is so short, you need some positive headline to be able to, stop out the shorts.
Right.
And we saw that one day when they postponed the tariffs for 90 days or whatever, and then crude and every macro thing just went up. So that's the danger on the upside. But the selling has been very relentless, and it's more in the back end of this year. So you're starting to see this really weird shape. I say weird because I've seen contango and then backward, but I haven't seen backward and then contango. And so you've got all this selling from specs, which is coming in the back end of this year. So your December 25, December 26 has actually gone contango. It's about minus $1.50. Yeah. So December 25, $1.50 under 26. And the front is about, as in month 1, month 2 is still about 50, 60 cents. And that's because Cushing inventories are very low. So that's that fundamental relationship, which is holding in the very front. And then you've got the
expectation
supply of selling in terms of swaps or specs, which is more in the back. And that's driving that back end shape.
Right. Yeah. U-shaped. Yeah. It is an interesting shape for sure. And on the inventory side, as you mentioned, Cushing low, but really when we look across, just overall lower 48 crude, you're not high. I mean, you're not at the base, but you're definitely running that year over year deficit pretty strong. Weekly changes for the last several weeks relative to last year. And then, I think products is really the interesting one that I'm watching.
Products are strong. Yeah. The inventories gasoline is now below average. It's drawing strong. This is the season for it to be drawing. Right. So it's seasonally drawing. And distillate is low. It's been low, and it's
getting lower. Yeah. But the rate of change on the U.S. gasoline stocks is also an interesting one. Comparing that to last year, the change there is much stronger. So it looks solid. And then, distillates, as you mentioned, we're at 107.8 million barrels for total US. And that's comparing to the 5-year seasonal average of 122 million. So you're pretty close to the bottom of the 5-year seasonal range. And, it kind of runs, I guess it contrasts against some of these demand narratives that are out there. And, we'll see what happens as OPEC brings back some of that supply. But as you mentioned with the products, I think that's kind of an interesting question to try and answer is what is substantiating this demand commentary? Because as we looked at the economic data, still fairly strong and, potential improvements in there as well. And then when you look at the underlying fundamentals, also fairly strong.
I mean, I'm going to throw in a little bit of politics here, but one of the things I was reading is this has been one of the widest forward expectations by which way you lean, whether you lean Democrat or Republican. It's like Republicans are more optimistic than they have been, and Democrats are more pessimistic than they have been. So that's showing up in when they do these surveys about what's your expectation of the economy and things like that. You've got a massive divergence. So I think when anyone is giving a take, so when you go from data to a narrative, who you talk to
exactly
really matters because it's so different in terms of what their viewpoint is.
Exactly. Yeah. The sampled population is probably, I've never answered one of those, Reuters or Bloomberg surveys. I don't know if you have, but it seems like the sample for that tends to skew, in one direction towards, I guess the more Democrat leaning side. So it is interesting. Also, I think that narrative would be interesting if that does play into kind of real world expectations, just, you believe what you read type of thing. But yeah, we'll see. I think those trade deals in Q2 will be particularly interesting, regarding like the announcements that have already been put out with India, for example, is really, as I mentioned, that demand growth driver for the next decade. I think one of those interesting confirmation pieces is that Apple is saying that they're going to move their iPhone manufacturing from China to India. And I think when Apple does that, one of the largest consumer goods sellers in the world, I think that's a pretty strong sign that we'll see more of that market move to India and some of the neighboring economies that are more aligned with the US. And I think there's benefits to India for doing that. Obviously, you get the consumer economy of the United States, you get some defense deals in there, and then you get energy as well. And so there's many, it's mutually beneficial. And I think to really confirm that as a bullish driver for, say, global crude markets, I think we'll just have to see, some kind of clear indication that industrial activity and also, refinery runs and other aspects in there are improving, which, they have been, but definitely one to watch. Yeah.
Right.
Yeah. Is there anything else on the broader side that you think is interesting? Maybe the talks between China and the US?
Yeah, I think that is interesting that I think maybe a couple of weeks ago when the US said, okay, we're not going to be putting tariffs on things which we really need from China. And then even though China has been saying very clearly that we are not going to back down, just I think in the last 24 to 48 hours, they kind of quietly said, okay, we're going to exempt things like ethane and propane imports and among other things. And I think they're also realizing there are certain things they cannot replace. And so they're not advertising that fact, but they're doing it.
It's a posture.
And they've also, exactly. And they've also come out and said, yeah, we are kind of open to negotiating on the trade stuff as well. So yeah, I think it will be interesting to see how the posturing versus reality goes.
Yeah. I think the ethane and propane, as you mentioned, that's a good signal. And just for context, last year, China was the biggest single importer of U.S. ethane. Over 46% of U.S. ethane went to China. And then just under 18% of U.S. propane exports went to China last year. So that's definitely by share, the largest energy that China buys from the U.S. LNG is, on and off, usually fairly nominal. And then crude is kind of give or take depending on other global flows. But I think that'll be definitely an interesting one. And, I think one thing to keep in mind for anybody listening that's thinking about the China side is really just to put the context of the U.S. consumer economy and the benefit that provides to China on a per capita basis. So on just a economy-wide look, China has relatively large purchasing power compared to the U.S., but on a per capita basis, the U.S. consumer is the wallet for a lot of these export-centric nations. And so, we have a lot of negotiating leverage to say, well, we'll just buy from somebody else. And if your goods are not clearly distinguishable from something that we can get from India, then, there might be some near-term restructuring pain, but otherwise, it's not like we're losing out on anything particular. I'd say within that, there is some exceptions for things like the critical minerals that will probably be a longer term pain point if, it really escalates. But I don't think that's in China's interest either.
Right. I think last time when we were talking here, one of the data points I gave was I think the US consumes about 35 to 40% of everything. Mm-hmm. So like you said, we can go to a different place to buy our stuff, but China already has factories all built and they cannot find a new buyer
that has the buying power.
Yeah. And in fact, I was reading that much as they claim that they are, in a strong negotiating position on the ground, I mean, you read some of the stuff which is going on, and there are a lot of factories which are actually shuttered, and there's already some unrest brewing, and that's what they cannot handle. That's what's going to push them to make a deal is when the labor force starts saying,
we can't sustain this.
We can't take this. And they start agitating. They cannot. There's too many people to, deal with. So.
Yeah, and that's, I think I might have mentioned this when we chatted last time, but China is the kind of definition of economy of scale. And so when you manufacture at that level of production, the rate that your backlogs will increase with any decrease in demand or rapid decrease in demand is going to be more painful than the person on the buying side of that. And so, it's not like you can just shut off hundreds of thousands of square feet of manufacturing capacity without any downside. So definitely one to watch. I think, we can keep it there and see what happens this weekend with OPEC's meeting that they moved to May 3rd and probably have some more news to cover next week. Yeah,
sure. I think the one thing which is not going away is volatility.
Yeah, absolutely.
Both up and down.
Yeah, absolutely. Absolutely. Well, definitely interesting next few weeks ahead. So look forward to chatting about whatever we see next. Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.